Michael, welcome back to the program. What about the stock market action these days? You know, a lot of people are still kind of jittery, sitting on the sidelines, but how are you seeing things?
Well, I think that's certainly how the market is playing out right now. There's just tremendous uncertainty here in the United States. We really are at a transition point. Unemployment really is not getting significantly better. Real estate market is not getting significantly better. Durable goods orders are not getting significantly better. But the economy is stabilizing. It's starting a very slow, sluggish recovery. You know, we're of the belief, Susan, that the economy is going to recover much slower than many people think. And so we're not surprised that these numbers are mixed. And for that reason, we think the markets are going to trudge along for a while, at least during the summer months, until there's more clarity about what's happening in the future in terms of the economy.
That's right. It looks like first quarter GDP numbers stuck at 1.8%, which is far less than estimates by economists. And then you have jobless claims, you know, on the rise again. I thought this trend was over, but it looks like it's come back since February. So what does this say to you? I mean, how are you playing the markets in reaction to these, shall we say, less than rosy GDP and economic numbers?
Yeah, you know, I think, first of all, you have to be fairly defensive here in the United States. I think you buy dividend-oriented stocks, you buy global assets, companies in the United States that have a significant percentage of the revenue outside of the United States. And I'll tell you, Susan, you know, the unemployment numbers really are very, very suspect numbers anyway. You know, in the United States, if you stop looking for work, even though you want a job, you're not counted in the unemployment ranks. So the numbers are all very suspect. We might say 9, 10%. The real unemployment rate in the United States, as well as underemployment, is closer to 15 to 16%. So for that reason, I think being defensive makes a lot of sense.
Okay, being defensive, so looking for dividend plays. But what else? What about the rest of the markets? I know you've been a big fan of commodities and gold, but there's been some mixed calls out there in commodities in recent weeks.
Well, so here's my view on commodities. I think if you take out oil and silver, oil, I think, is going to stabilize maybe between $90 and $95 a barrel. I think it's priced just too high right now, given the supply that's out there and the demand. And then secondly, silver is more down near $35 an ounce, basically because margin requirements were basically tightened. Besides that, other commodities, copper, food products, and gold, certainly, we think commodities are a place investors need to have a percentage of their assets for a few reasons, or two reasons. First of all, as a hedge against inflation that we think ultimately will come, not this year, but next year. And then secondly, emerging market growth, no matter how disappointing some say 8% GDP growth in China is, that's still probably going to be 4 times greater than the United States. And these emerging economies are going to continue to consume commodities. You see it there in Asia in terms of the building that's going on from Singapore to Shanghai, and I just don't think that's going to stop.
Okay, well, what about the European side? I mean, a lot of people are getting shaky knees over, again, looks like this recurrence of sovereign debt concerns. What about you?
You know what? We have been, to use your expression, shaky knees, we have been in that continual state. You know, we're of the belief that Europe really has tremendous systemic problems. You have really a collection of countries in the European Union, all with different economic conditions. You have Germany very strong. Obviously, you have Greece very weak. So what does Claude Trichet do from an interest rate policy standpoint? He does not have the mandate to try to impact the economies of these countries. All he can do is really adjust interest rates to cope with inflation. So if inflation gets out of hand in Germany and he raises rates, what's that going to do for borrowing costs for places like Portugal and Italy and Greece? So I think Europe has a ways to go. Not just this year. I even think next year Europe has a deleveraging process they still need to go through.
All right.